Welcome to today's program. I'm glad you've joined us for what I believe will be one of the most important conversations you can have about your financial future. In the next several minutes, we're going to walk through the Social Security landscape as it stands heading into 2026. And more importantly, we're going to discuss practical strategies that can help you keep more of the money you've earned over a lifetime of work. Before we begin, I want to acknowledge something. Talking about retirement income can feel overwhelming. The rules seem complicated, the numbers can be confusing, and there's a lot of conflicting advice out there. My goal today is to cut through that noise and give you clear, trustworthy information that you can actually use. No political spin, no fear tactics, just straightforward guidance designed to help you make better decisions for yourself and your family. Now let me start with a question that might surprise you. What if I told you that a single decision, specifically when you choose to start receiving your Social Security benefits, could mean the difference of hundreds of dollars every single month for the rest of your life? That's not an exaggeration. The timing of your claim, combined with a few other strategic choices we'll discuss today, can dramatically affect how much money lands in your bank account each month during retirement. Over the course of 20 or 30 years, we're talking about tens of thousands of dollars in cumulative difference. Today, I'm going to share 4 proven strategies that can help you maximize your Social Security benefits in 2026 and beyond. We'll talk about the power of delaying your benefits, how continuing to work can actually increase your monthly check, what you need to know about the earnings test if you plan to work while receiving benefits, and finally, how to understand and plan around cost of living adjustments and Medicare deductions. Each of these strategies builds on the others, and by the end of this video, you'll have a much clearer picture of how to approach your own retirement planning. If you find this information helpful, I'd encourage you to subscribe to this channel and turn on notifications so you don't miss future updates on Social Security and retirement planning. These rules change from year to year, and staying informed is one of the best things you can do for your financial security. Now let's get started with our first strategy. Strategy 1. Understanding the power of delayed retirement credits. Our first strategy focuses on perhaps the single most impactful decision you'll make regarding Social Security, which is choosing when to start receiving your benefits. This decision matters because Social Security is designed to pay you different amounts depending on when you begin collecting. The system is structured so that claiming earlier means smaller monthly checks, while waiting longer means larger ones. And the difference isn't minor, it's substantial. Let me explain how this works. The Social Security Administration assigns everyone what's called a full retirement age, often abbreviated as FRA. This is the age at which you're entitled to receive 100% of your earned benefit, calculated based on your lifetime earnings. For anyone born in 1960 or later, your full retirement age is 67 years old. This is important to note because the first wave of people with a full retirement age of 67 will reach that milestone in November of 2026. If you were born before 1960, your full retirement age might be slightly younger, perhaps 66 or 66 and a few months, depending on your exact birth year. Here's where the strategy comes in. You're allowed to claim Social Security as early as age 62, but doing so comes at a significant cost. If you claim at 62 instead of waiting until your full retirement age of 67, your monthly benefit will be permanently reduced by approximately 30%. That reduction stays with you for the rest of your life. On the other hand, if you delay claiming past your full retirement age, something remarkable happens. For every year you wait beyond your full retirement age, up until age 70, your benefit increases by 8%. That's not 8% one time. That's 8% per year, compounding on your base benefit. If you break that down, it works out to roughly 2/3 of 1% for every month you delay. A common mistake people make is assuming they should claim as soon as possible to get money while they can. The reasoning usually goes something like this. I've paid into the system my whole life. I want to start getting something back. That's an understandable feeling, but it often leads to a decision that costs people money in the long run. Unless you have serious health concerns or an urgent financial need, claiming early typically means you'll receive less total money over your lifetime compared to someone who waits. Let me give you a realistic example. Imagine a person whose full retirement age benefit is $2,000 per month. If they claim at 62, that amount drops to around $1,400 per month due to the early claiming penalty. That's $600 less every single month. Now, if that same person waits until age 70 instead of claiming at 67, their benefit increases by 8% for each of those 3 years, which means they'd receive approximately $2,480 per month. The difference between claiming at 62 and waiting until 70 is over $1,000 per month. Over 20 years of retirement, that adds up to more than $240,000 in additional lifetime benefits. Of course, I want to offer an important word of balance here. This strategy isn't right for everyone. If you have health issues that might limit your life expectancy, or if you genuinely need the income to cover essential expenses, claiming earlier might be the right choice for your situation. The best decision depends on your personal health, your financial needs, your other sources of retirement income, and your family situation. But for those who have the flexibility to wait, the math strongly favors delaying as long as possible, up to age 70. Strategy 2. Working longer to strengthen your lifetime earnings record. Our second strategy involves something that many people don't fully understand, which is how your Social Security benefit is actually calculated. This matters because once you understand the formula, you'll see how working longer, especially in your later years, can directly increase the size of your monthly check. Here's how the system works. The Social Security Administration looks at your entire earnings history over your working life. From that record, they identify the 35 years in which you earned the most money, after adjusting for inflation. They then average those 35 years of earnings to arrive at what's called your average indexed monthly earnings. That average is plugged into a formula that determines your monthly benefit. The key insight here is that if you don't have 35 years of substantial earnings, the formula fills in the missing years with zeros. Those zeros pull down your average and reduce your benefit. Here's how working longer helps. If you continue working past your full retirement age, especially if you're earning a solid income, those additional years of earnings can replace earlier years when you earned less. Maybe you took time off to raise children, or perhaps you started your career with low-paying jobs, or you had periods of unemployment. Every year you work now at a higher salary can knock out one of those lower earning years in your top 35, which raises your average and therefore increases your monthly benefit. A common misunderstanding is thinking that once you reach retirement age, continuing to work doesn't affect your Social Security anymore. That's not accurate. The Social Security Administration recalculates your benefit annually if you continue earning income. If your recent earnings are higher than one of the years currently in your top 35, the new year replaces the old one, and your benefit is adjusted upward. Let me illustrate with an example. Consider a woman who worked for 30 years and then took 5 years off before returning to work at age 63. Her Social Security calculation includes 5 years of zero earnings because she doesn't have a full 35 years of work history. If she earns $60,000 per year for the next 4 years, each of those earning years replaces a zero in her record. This could increase her monthly benefit by $100 to $200 or more, depending on her specific circumstances. That extra income continues for the rest of her life. There are additional benefits to working longer beyond just the Social Security calculation. You continue contributing to retirement savings, you delay drawing down your nest egg, and you may maintain employer-sponsored health insurance until you're eligible for Medicare. All of these factors contribute to a more secure retirement. However, I want to acknowledge that not everyone can work longer. Some people face health challenges, job loss, caregiving responsibilities, or physically demanding work that becomes impossible to continue. This strategy is most relevant for those who have the option and desire to keep working. If that describes you, understand that each additional year of earnings is doing double duty, providing income now while also boosting your Social Security check for the future. Strategy 3. Navigating the earnings test. If you work while receiving benefits. Our third strategy addresses a situation that trips up many people, which is what happens when you choose to receive Social Security benefits while continuing to work before you've reached your full retirement age. This matters because there's a rule called the Retirement Earnings Test that can temporarily reduce your benefits if your work income exceeds certain limits. Let me explain how this test works. If you claim Social Security benefits before reaching your full retirement age and you continue to work, the Social Security Administration places a limit on how much you can earn from employment without affecting your benefits. In 2026, that limit is $24,480 per year for those who won't reach their full retirement age during the year. If your earnings from work exceed that threshold, Social Security will withhold $1 from your benefits for every $2 you earn above the limit. For example, let's say you're 64 years old, you've claimed Social Security, and you're receiving $1,500 per month in benefits. You also work part-time and earn $34,480 during the year. That's $10,000 over the $24,480 limit. Under the earnings test, Social Security would withhold $5,000 from your benefits that year, which works out to roughly 3 months of withheld checks. Now here's something important that many people don't realize. The money that's withheld isn't gone forever. When you reach your full retirement age, Social Security recalculates your benefit to give you credit for the months when benefits were withheld. Your monthly amount is adjusted upward to account for those lost payments, so over time, you essentially get that money back through higher future benefits. However, in the short term, having checks reduced or stopped entirely can create real cash flow problems if you're counting on that income. A common mistake is not planning for this reduction. People start collecting benefits, take on a part-time job, and are surprised when their Social Security checks suddenly shrink. If you're going to work while receiving benefits before full retirement age, you need to either keep your earnings below the limit or prepare financially for the temporary reduction in benefits. There's also a different rule for the year in which you reach your full retirement age. In that specific year, the earnings limit is higher and the withholding rate is lower, $1 for every $3 earned above the limit, rather than 1 for 2. And once you've reached your full retirement age, the earnings test disappears entirely. You can earn as much as you want from work without any reduction to your Social Security benefits. This is another reason why reaching full retirement age before claiming, or at least before working significantly, can simplify your financial planning. Let me offer a practical scenario. Imagine a man who is 63 and considering whether to claim Social Security while continuing to work full-time, earning $50,000 per year. Given the earnings test, a significant portion of his benefits would be withheld. In this situation, it might make more sense for him to delay claiming until he either reduces his work hours, earns less, or reaches his full retirement age. By waiting, he avoids the complexity of the earnings test and allows his future benefit to grow through delayed retirement credits. As always, individual circumstances matter. Some people need the income from both work and Social Security to make ends meet, even knowing that some benefits will be temporarily withheld. If that's your situation, just make sure you understand how the earnings test works, so there are no unpleasant surprises. Strategy 4. Understanding cost of living adjustments and Medicare premium deductions. Our fourth and final core strategy involves two connected pieces of the retirement puzzle that often confuse people: the annual cost of living adjustment to Social Security benefits and the Medicare premiums that are typically deducted from your Social Security check. Understanding both of these is essential for accurate financial planning. Let me start with the cost of living adjustment, commonly referred to as COLA. Each year, the Social Security Administration reviews changes in the cost of living and adjusts benefits accordingly. This adjustment is designed to help your purchasing power keep up with inflation. When prices rise, your benefit should rise too, at least in theory. For 2026, the cost of living adjustment is projected to be approximately 2.8%. For the average retiree, that translates to roughly $56 more per month. This sounds like good news, and in many ways it is. Without these annual adjustments, the value of your benefits would erode over time as prices increase. However, there's a catch that many retirees don't anticipate until they see it happen. Medicare Part B premiums, which cover doctor visits and outpatient services, are typically deducted directly from your Social Security check. And those premiums also tend to increase each year. In 2026, the standard Medicare Part B premium is expected to be $201.90 per month. For some retirees, especially those who are paying lower premiums in previous years, this increase can eat into or even exceed the cost of living adjustment. In other words, you might see your gross Social Security benefit go up by $56, but after the Medicare premium increase, your actual take-home amount might only go up by $20 or $30, or in some cases, it might not increase at all. A common misunderstanding is assuming that the COLA increase means you'll automatically have more spending money. In reality, you need to subtract the Medicare premium increase to understand your true net benefit change. This is why I always encourage people to look at the actual deposit amount in their bank account, not just the headline COLA number they see in news reports. Here's a practical example. Let's say you currently receive $1,800 per month from Social Security. A 2.8% increase would add about $50 to your benefit, bringing it to $1,850 before deductions. If your Medicare Part B premium increases by $15 compared to the previous year, your net increase is only $35. That's still an increase, but it's noticeably less than the $50 you might have expected. For planning purposes, I recommend building a simple budget that accounts for both your gross Social Security benefit and your expected Medicare deductions. This gives you a realistic picture of your monthly income. Also, be aware that if your income is above certain thresholds, you may be subject to income-related monthly adjustment amounts, which means you'd pay higher Medicare premiums. This is based on your tax return from 2 years prior. So a year of unusually high income, perhaps from selling property or taking a large retirement account distribution, can trigger higher premiums down the road. The balanced perspective here is that COLA increases are genuinely helpful, and the Social Security system's automatic inflation adjustments are an important feature that many private pensions don't offer. But smart planning requires looking at the whole picture, including the deductions that come out of your benefit each month. Summary and final thoughts. We've covered a lot of ground today, so let me briefly summarize the 4 strategies we discussed for maximizing your Social Security benefits in 2026. First, we talked about the power of delayed retirement credits. If you can wait to claim your benefits beyond your full retirement age, you'll receive an 8% increase for each year you delay, up to age 70. For many people, this patience pays off substantially over a long retirement. Second, we explored how working longer can strengthen your lifetime earnings record. Because Social Security calculates your benefit based on your highest 35 years of earnings, additional years of good income can replace earlier, low-earning years and boost your monthly check. Third, we examined the earnings test that applies if you work while receiving benefits before reaching full retirement age. Keeping your earnings below $24,480 in 2026 helps you avoid temporary reductions to your benefits, and understanding how this rule works can help you plan more effectively. Fourth, we discussed cost of living adjustments and Medicare premium deductions. The 2026 COLA of approximately 2.8% is welcome news, but you should factor in rising Medicare Part B premiums when calculating your actual monthly income. Now, before we close, I want to share one bonus insight that many people overlook, and it's critically important. Before you can receive any Social Security retirement benefits, you must have earned at least 40 work credits over your lifetime. You earn credits by working and paying Social Security taxes, and in 2026, you'll receive 1 credit for every $1,890 of earnings, up to a maximum of 4 credits per year. Most people who've worked regularly for 10 or more years will have the required 40 credits, but it's worth checking. You can verify your credits and your entire earnings history by creating an account at the Social Security Administration's official website at ssa.gov. I strongly encourage everyone to review their earnings record regularly. Mistakes happen, and if the Social Security Administration has incorrect information about your past earnings, it could affect your benefits. The earlier you catch and correct any errors, the better. This is especially important for people who changed jobs frequently, worked for employers who may not have reported wages correctly, or had periods of self-employment. As we come to the end of today's program, I want to leave you with an encouraging thought. The decisions you make about Social Security don't have to be stressful or confusing. Yes, the rules are detailed, and yes, there are many factors to consider. But the fundamental principles are straightforward, and now you understand them. Delay if you can. Keep working if it makes sense for you. Understand how your earnings affect your benefits, and keep an eye on both COLA increases and Medicare costs. These are decisions that will shape your financial life for decades to come. Taking the time to understand your options and make informed choices is one of the best investments you can make in your own future security. If you found this video helpful, I'd be grateful if you take a moment to like it and subscribe to this channel. Sharing this video with a friend, spouse, or family member who might benefit from this information is one of the most meaningful things you can do, because conversations about retirement planning are conversations about security, dignity, and peace of mind. If you have questions or topics you'd like me to cover in future videos, please leave them in the comments below. I read every comment and use your feedback to create content that addresses your real concerns. Thank you for spending this time with me today. I wish you clarity, confidence, and a retirement that reflects the lifetime of work you've invested. Take care, and I'll see you in the next video.